Adian Bank has just dropped a $40 target on silver, not $70. Not a modest pullback, $40. And that number isn't a forecast. It's a fire alarm they're hoping you'll hear so loudly that you panic, run for the exit, and hand them your medal on the way out. Because when you strip away the theatrics, here's what actually happened. TD Securities opened a fresh short position in silver around $78, publicly declared that price is heading to $40, and quietly placed a stop somewhere near $92. In plain language, they're daring silver to get cut in half, and the timing tells you everything you need to know. Silver just tore through 2025 like a blowtorch, up roughly 150% on the year, printing an $84 handle before cooling off into the high 70s and low 80s. Right in that cooling zone, TD steps in and declares a crash. That's not coincidence, that's strategy. Now remember, this is the same shop that tried to short silver back in October 2025 when it first broke above $50. And they didn't just get it wrong, they got run over. That position was closed for a loss of roughly $2.4 million. That's not opinion, that's scar tissue on their P&L. So ask yourself a very simple question. If they already touched the stove and got burned, why are they grabbing the hot pan again? Because this isn't just analysis, this is pressure, this is narrative warfare. And if we don't recognize the game, we become the liquidity. Let's level set for a moment. We're here to read what the big desks are doing, cut through the noise, and map risk like adults. This is educational. We manage risk. We don't worship positions. With that framework in place, TD's new short is being marketed as smart positioning, but it smells far more like desperation than confidence. Because to make a short work at this stage of a bull market, you need one thing above all else: sellers. You need weak hands to panic. You need chart watchers to puke their positions. You need someone to smash market sell so your desk can quietly buy back without blowing up the price. And that's exactly why a dramatic $40 target gets blasted into the public. It's not subtle, it's not balanced, it's designed to shock you. TD's bearish case leans on three core ideas: a mechanical dump, a demand destruction narrative, and a story about hidden supply. Let's walk through each one carefully and notice what happens when paper logic meets physical reality. First, the mechanical dump. TD claims that passive index rebalancing could force roughly 13% of total open interest to be sold on the COMEX over the next couple of weeks. They're waving that number like a guillotine. But here's the mistake most people make. They hear scheduled selling and imagine a surprise ambush. Rebalancing isn't an ambush, it's a calendar event. Markets front-run calendars. Big players don't wait for the bell and then smash buttons like amateurs. They drip, hedge, spread, and pre-position. By the time the event actually hits, much of the pressure has already been absorbed. Yes, you can get volatility. Yes, you can get air pockets. But a clean 50% collapse from a known scheduled event isn't analysis, it's storytelling. And storytelling is exactly what shorts rely on when fundamentals are against them. The second pillar of their argument is the idea that high prices heal the market. According to this story, demand is being destroyed, recycling will surge, and inventories will rebuild. On the surface, it sounds reasonable. But look closer. Silver isn't a luxury handbag. It's an industrial input. Solar manufacturers don't get to say, silver is expensive this quarter, let's skip it. Electronics makers can't redesign supply chains overnight. Industrial demand is sticky. It doesn't pivot on headlines. And while some discretionary demand like jewelry can soften at the margins, that's not the engine driving this market. The real question is simple. Even if some demand eases, does supply suddenly surge enough to justify $40 silver? Because prices don't collapse unless supply overwhelms demand or demand collapses outright. This is where the recycling argument falls apart. Recycling isn't a magic faucet you can turn on overnight. You don't double recovery rates because price printed $84. Recycling requires collection systems, sorting, processing capacity, capital investment, and time. Months, years, not 2 weeks. So when someone tries to link a near-term rebalancing event to a sudden recycling boom that halves the price, that's not a logical chain. That's a paper bridge built on hope. The third argument is hidden supply through inventories and tariffs. TD suggests that metal currently sitting in U.S. vaults could flow back out and replenish London, easing physical tightness. But metal doesn't teleport. Physical silver moves like freight, not like numbers in a spreadsheet. That metal moved into U.S. vaults for a reason: risk management, logistics, policy hedging, custody preferences. And if you're a holder who just watched silver nearly triple in a year, why would you rush to ship it back across oceans because a bank published a note? Storage is cheap compared to regret. Shipping is expensive compared to patience. Serious holders don't flip physical like a meme stock. Yes, some flows can reverse, but the idea of a sudden flood back to London is a hope trade, not a supply schedule. Now let's talk about what they're not talking about, because this is where the paper story collides with reality: China. If you're only watching New York, you're missing the heartbeat of this market. Shanghai has been paying persistent premiums that make arbitrage traders salivate. When you can buy in the West and sell in the East for a spread, that's not sentiment. That's demand. That's metal being pulled. And when Eastern buyers are willing to pay up for physical, paper dumps turn into discounts, not death blows. Ask yourself this. If you're short, what do you fear most? A dip that gets aggressively bought, a dip that tightens physical supply even further, a dip that drains what little metal remains in the visible pipeline. That's how squeezes are born, not from hype, but from flow. From the moment the market realizes paper claims are expanding faster than deliverable metal. Then there's solar, the quiet monster in the room. Installations keep growing, capacity keeps expanding, factories keep stamping panels, and every time solar ramps, silver is consumed, not stored. It's destroyed into product. There's no clean substitute that matches silver's conductivity at scale without serious trade-offs. People love to say thrifting will solve it. Sure, manufacturers try, but thrifting has limits. The curve isn't infinite. Even with efficiency gains, the direction of demand remains up and the metal still has to show up on a loading dock. Zoom out one more layer and look at mine supply. This is where the $40 dream collides with geology. Silver production hasn't surged. New mines don't appear because a desk wants a lower price. Exploration was starved during years of low prices. Projects take years to permit, finance, build, and ramp. Grades decline, costs rise, diesel, labor, water, politics. None of that improves just because a bank wants a cleaner chart. The facts are stubborn. The market has run persistent deficits for years. Above-ground inventories have been drawn down to fill gaps. Supply growth is slow. For the crash narrative to work, it needs a miracle. And miracles don't show up on the COMEX. Now we need to address the uncomfortable part, short exposure. There are credible reports showing that major bullion banks collectively sit on enormous short positions that, in ounce terms, exceed annual global mine supply. This isn't about conspiracy. It's about incentives. If you're short that much metal, you don't want a steady climb. You want fear. You want volatility. You want headlines that force people to sell. So when a major institution publishes a dramatic $40 target, the question isn't whether it's bold. The question is who it benefits. Look at the mechanics of TD's trade. Short around $78, target $40, stop near $92. On paper, the risk-reward looks attractive. Risk about $14 to make $38. But silver isn't polite. It's a street fight. It can move 5% in a single day. It can gap on geopolitics, currencies, or one unexpected supply headline. A $92 stop isn't a fortress. It's a tripwire. And here's the question professionals ask quietly, if they're so confident, why announce it? Why not just trade it? Because public calls aren't about edge. They're about influence. They're about shaping behavior. They're about creating sellers. Bull markets don't go straight up. They breathe. They coil. And every time they coil, the same script appears. This is the top. Demand is dying. Inventory is coming back. Weak hands sell. Strong hands absorb. Then the trend resumes. So when TD calls for $40 right after a historic run, it looks less like insight and more like a test. They're probing confidence, throwing a scare grenade into the room. And the grenade only works if we panic. So what do? We don't guess. We measure. We watch the spread between paper and physical. We watch premiums. We watch Eastern pricing. We watch inventories that can actually be delivered, not promises on screens. We watch whether dips get bought. Because if dips keep getting bought, the short thesis doesn't just fail, it becomes fuel. A very plausible path from here is simple. Rebalancing creates a pullback. We see $72, $73, maybe an ugly flush candle that looks terrifying on your phone. Headlines scream collapse. Social media turns into a funeral. And then the floor shows up. Eastern buyers lean in. Arbitrage tightens. Physical stays bid. Price starts walking higher again. If that happens, TD is trapped once more. And here's the nightmare for any public short. Stops are magnets. As price approaches them, buying accelerates because everyone knows where they sit. The very protection meant to cap losses becomes the trigger for the next leg higher. And let's be honest about $40. At that price, marginal supply gets squeezed, projects get delayed, capex gets cut. That doesn't heal the market. It tightens it. The bearish thesis fights itself. It needs prices low enough to scare sellers, but low prices destabilize supply. The only way the $40 story works is if demand truly breaks. And if that's happening, it won't show up in a research note. It will show up in collapsing premiums, rebuilding inventories, and a dead bid in the East. Until then, paper and physical are telling different stories, and one of them is lying. None of this means price can't dip. We respect volatility, but we also respect incentives. TD already lost on this trade once. They're trying again at higher levels with a louder megaphone. That's not confidence. That's a desk trying to reclaim reputation and P&L. The facts are clear. TD is short silver again. Their public target is $40. They were wrong last time. Their catalysts rely heavily on near-term paper mechanics and speculative supply flows. That means the trade needs fear to work. And fear is exactly what they're trying to manufacture. If the market refuses to cooperate, if rebalancing gets absorbed and price holds the high 70s or reclaims the $84 area, the entire "this is over" narrative collapses. And when narratives break, silver doesn't punish gently. It humiliates bad shorts. It gaps higher, forces cover, and does it at the worst possible moments. So we stay focused. We watch the levels near their stop. We watch whether price accelerates as it approaches. We watch premiums. We watch the East. And we don't hand over our positions just because a bank told us to be scared. We're not gambling, we're measuring. If you want us tracking what the big desks are doing in real time, make sure you subscribe to the channel. This is John Money Discipline. Hit subscribe, stay sharp, and stay disciplined, because the next chapter in this story won't be written by a research note. It will be written by price when liquidity disappears, and when that moment comes, we won't guess. We'll read the signals together.